Viewers at home, you are welcome to my presentation on change in accounting date. Change in accounting date. In this presentation, I will examine the meaning of change in accounting date, steps for solving problems involving change in accounting date, procedures or the principles used in identifying the year of change, and I will also solve questions as work example. If you are just coming across the YouTube channel for the first time, or if you have not subscribed in the past, please hit the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. What is change in accounting date? A change in accounting date occurs when a company prepares its accounts to a new year end that is different from its old accounting year end. When a business or when a company prepares its accounts to a new year end that is different from its old accounting year end, then the business is said to have changed the accounting date. Supposing XYZ Limited, if the year end of XYZ Limited, if it is December 31st of December every year, but as at this year end, the staffer or the staff may be busy that they may not have time to formalize their account. So they might decide to change their year end to maybe March 31st every year. So that means the business year end have changed. One of the reasons for the change in accounting date is the avoidance of peak period. A peak period is usually a busy time for the business, so that they might not have time to prepare their financial statement during that period. So as a result of that, they may decide to change their accounting date. Reasons for changing accounting date includes: number one, avoidance of peak period. Avoidance of peak period. Number two reason is the business may want to prepare the account that coincide with the government year end. They may want to prepare it so that their year end will coincide with that of the government. These are the reasons for change in accounting date. What are the steps for solving problems involving change in accounting date? Steps for solving change in accounting date. Step one is to identify the year of change. Identify the year of change. The year of change, the year when the business fails to prepare its account to the old accounting year end. The year the business fails to adopt their old accounting year end, that year is said to be the year of change. This will be the first tax year of the business under change in accounting date. You identify the year of change. I think the year the business fails to prepare the account to the old accounting year end. Number two is to identify the 2 years following it. Identify the 2 years following it. That is, the 2 years following the year of change. If you have identified the year of change and the other 2 years that follows it, that means you are having 3 years you have identified. So identify the year of change, then you identify the 2 years following it. Step 3 is to compute the assessable profit for the 3 years using the old accounting date. Compute the assessable profit for the 3 years identified above using the old accounting date. Now you have identified 3 years. Number 1 is the year of change and 2 years that follow. You are going to compute the assessable profit for the 3 years identified using the old accounting date. Step 4. Repeat the step 3. Step 3 using the new accounting date. That is, compute the assessable profit for those 3 years as well using the new accounting date. Step 5. You add up separately. Your computation is step 3 and 4. Add up separately your computation in step 3, 3 and 4. In step 3 and step 4 above, you add up separately your computation in step 3 and 4 above. Step 6. It is the practice of revenue to select the higher assessable profit from step 4 and for step 3 for the result obtained in step 5. It is the practice of revenue to choose the higher assessable profit in step 5. You know, you are having 2 accessible profits in step 5. The one based on the old accounting date and the one based on the new accounting date. Whichever one is the higher should be chosen. So, principle for identify the year of change. Identification of the year of change. Identification of year of change. The principle used in identify the year of change is called consistency principle. Consistency principle. That is the principle used in identifying the year of change. By consistency principle, it means once a period has been selected, that period must be followed consistently. That means any year the business fails to follow or fails to use the old period they have been using, that year is the year of change. Once a year has been selected, once a year has been chosen, that year must be followed consistently. The year the business fails to adopt the old year end is the year of change. Let us consider the following 3 scenarios for identifying the year of change. Remember, I've told you that the principle involved is the consistency principle. Once a year has been chosen, or once the accounting year end has been chosen by the organization, that year end must be followed consistently from year to year. Now, look at scenario 1. This entity adopted 31st October as the year end in 20X1. In 20S1, that year was complied with. That October 31st was complied with. In 20S2, the same October 31st was equally complied with. But in 20S3, yes, in 20S3, the same October 31st was complied with. That means the year was followed. October 31st was adopted consistently for 20S1, 20S2, and 20S3. But what now happened in 20X4? In 20X4, you are expecting October 31st again. But instead of this entity to adopt October 31st at the year end in 20X4, the entity now adopts March 31st in 20X4. Therefore, the year this entity fails to adopt October, which is 20X4, is the year of change. Therefore, in scenario 1, the year of change is 20X4. The year the entity fails to adopt October 31st. Now, let's look at scenario 2. Scenario 2. This entity adopted June 30 in 20X1. 20X1, the year end is at June 30. In 20S2, the same year end was adopted. Then you are expecting June 30 in 20S3. But in 20X2, the entity still adopts, the entity now adopts December 31st. 20S2 is not the year of change, since June 30 can still be obtained within the 20S2 year end. Therefore, this is 20S2 is not the year of change. The next period you are expecting is June 30, 20X3. Instead of the entity to adopt June 30 in 20S3, the entity, after preparing the account to June 30, 20S2, the entity also prepared it to December 31st, 20S2. I've told you that December 31st, 20S2 is not the year of change. If you have chosen to use 20S2 as the year of change, that means your computation will be wrong. So in this case, the 20S3, when this entity fails to adopt June, is the year of change. Therefore, in scenario 2, year of change is 20X3. The year this entity fails to adopt June 30. The year the entity fails to adopt June 30 is 20S3. Remember, the entity still adopt June 30 in 20S2 before changing to December 31st in 20S2. Therefore, the year of change is 20S3. So the two subs following year will be 20S4 and 20S5. So let's look at scenario 3. Scenario 3. Year ended is December 31st, 20X1. In 20X1, this entity adopts December 31st. In 20S2, December 31st was still adopted, following the consistency principle. That means you are expecting December 31st in 20S3. But instead of the entity to prepare the account to December 31st in 20S3, the entity did not even prepare account at all in 20S3. The entity prepares its account in 20S4. Therefore, year of change is the year this entity fails to prepare the account to December 31st. And that year is 20X3. Is 20X3, not 20X4. If you have chosen to use 20X4 as the year of change, your computation will be wrong. I know some people, because they've seen 30th of April 20S4, they will believe that 20S4 is their year of change. I've told you the year of change is not 20X4. Following the consistency principle, 20S1 December, 20S2 December, you are expecting December in 20S3, but there is no 20S3 at all until you now get to 20S4 and see April. Therefore, 20S3 is the year of change, the year the entity fails to adopt December 31st. So now, having explained how to identify the year of change, I therefore want to take a work example. Now let's look at this question. Ezikan had been preparing accounts to June 30 for many years. In 2022, he decided to change his accounting date to September 30 of every year. His adjusted profits in recent years are as follows. Year ended 30th of June 2020, 800,000. Year ended 30th of June 2021, 840,000. Year ended 30th of June 2022, 720,000. Period ended 30th of September 2022 is 240,000. Year ended 30th of September 2023, 480,000. Year ended 30th of September 2024, 360,000. Year ended 30th of September 2025, 400,000. You are required to compute the assessable profit for all relevant years of assessment, taking into account the practice of the revenue. Now, you have to compute the assessable profit for all relevant years of assessment. That means, remember, the principle in use is preceding year basis. The profit for 2025, that will be assessed in 2026. That means you are going to compute the assessable profit up to 2026 year of assessment. Now, the profit for 2020 will be assessable in 2021. That means the year of assessment should be from 2021 to 2026. Remember the principle in use. I'm not considering changes in accounting date yet. This profit of 2020 will be accessible in 2021. And this profit for 2025 will be accessible in 2026 on preceding year basis, PYB. Now, the name of the entity is Ezikan. You put Ezikan. Ezikan. Computation of accessible profit. For, the examiner says for all relevant years of assessment. I've told you that you have to state the years of assessment. Don't put relevant years of assessment. No mark will be awarded to you if you put for relevant years of assessment or if you put for all relevant years of assessment. So that is why I said you identify where you are going, the year of assessment will start. The first profit of 2020, I've told you it will be accessible in 2021, while profit of 2025 will be accessible in 2026. So, computation of accessible profit for 2021 to 2026 years of assessment. Year of assessment, basis period, and the accessible profit. The first year of assessment is 2021. 2021. Now, before I start this, remember this question. Since the entity have adopted June in 2020, June in 2021, June in 2022, September in 2022 again, the entity have changed their accounting date. Since the accounting date has been changed, that means this question involves changes in accounting date. The year of change is following the consistency principle. In 2020, they've adopted June. You are expecting June in 2021, which is there. You are expecting June in 2022, which is also there. You are expecting June in 2023, but instead of 2023, instead of the entity to adopt June in 2023, they now use September in 2022. The year the entity fails to adopt June 30, which is 2023, that year is the year of change, not 2022. If you use 2022, your computation will be wrong. Therefore, your year of change is 2023. Some people might think, since they've seen September 2022, which does not comply with June 2022, they might think 2022 is the year of change. That is not. 2023 is the correct year of change. Now, but before 2023, no, if you identify 2023 as the year of change, the two other subsequent years will be 2024 and 2025. Following the principles now, that means if you want to use the change in accounting date, you have 2023, 2024, and 2025. Those are the 3 years: 2023, 2024, and 2025. Those are the years you are going to apply changes in accounting date to. But for 2021, 2022, and 2026, any other years apart from these 3 years, you have to use the PYB, preceding year basis. Now, for 2021 year of assessment, the profit for 2022 year end, for 2020 year end, which is 800,000, that profit will be accessible in 2021 on preceding year basis. Preceding year to 2021 is 2020. This ended as at June. That means it will have started from 1st of July or 2019. So the basis period will be 1st of July 2019 to 30th of June 2020. And the accessible profit for that period is 800,000. I'm not solving for changes in accounting date yet. Then 2022, preceding year basis. 1st of July, preceding year to 2022, we end as our 2021. 1st of July 2020 to 30th of June 2021. And how much is the profit for the year end 2021? The profit for the year end June 30, 2021 amounted to 840,000. 840,000. Then 2023. 2023 is the year of change. You are going to apply the principles for changes in accounting date for 2023. The same thing, the 2 other subsequent years will be 2024. And the years that follows is 2025. You are going to apply changes in accounting date till these 3 years. No, if 2023 is the year of change, the 2 following years are 2024 and 2025. But remember, you want to compute your accessible profit for all to 2026. 2026. Preceding year basis will still be used for 2026. The last profit is the profit. The profit that will be accessible in 2026 on preceding year basis is the profit for 2025, which amounted to 400,000. So, and the year end is September 30. So we have 1st of October 2024 to 30th of September 2025, and the profit amounted to 400,000. This is the profit that will be accessible in 2026. We are now left with those 3 years that involves changes in accounting date. Now, workings now. We said 2023 is the year of change. If 2023 is the year of change, so now let's use the old accounting date. No, the old accounting date adopted by this entity is June 30. Now, year of assessment under change in accounting day. The first year is 2023. We have 1st of July 2021 to 30th of June 2022. The old accounting date ended as at 30th of June. Therefore, if preceding year basis PYB is used, the preceding year to 2023 will end as at 2022. Therefore, the basis period for 2023 year of assessment will end as at 30th of June 2022. Therefore, it must have started from 1st of July 2021, PYB. Therefore, you look for the profit that is aligned, that is in line with this basis period from 1st of July 2021 to 30th of June 2022. Back to the question. Profit for the year end as at 30th of June 2022. For the year end, June 2022, which must have started from 1st of July 2021, amounted to 720,000. Therefore, you have the accessible profit for that year to be 720,000. After 2022, the next year that follows is 2024. If preceding year basis is used, and using the old accounting date that ended as at 30th of June every year, therefore the 2024 accounting year will end as at 30th of June 2023 using old accounting date, which is June 30. So the preceding year to 2024 is 2023. If that ended as at 30th of June 2023, the period must have commenced from 1st of July 2022. Therefore, look for profit that is in line with this period from July 2022 to June 30, 2023. Back to the question. We didn't have profit that is in line with that period. But the first period of profit we were given is the profit for the period ended September 2022. And we are looking for profit from July 2022 to June 30, 2023. Now, we can get profit for July 2022 here from this September profit. How many? Now, notice September profits must have started from 1st of July 2022. Since the last accounting year end is June 30, 2022. That means this is profit from July 2022. You can get July 2022, August 2022, and September 2022. That is to show that this profit of 240,000 is the profit of 3 months. And this 3 months is part of the basis period we are looking for. So, and remember, we are looking for profit up to June. And you are not given profit from October 2022 to September 2023, which is a profit of 12 months. This is 12 months profit. But we are still in need of additional 9 months here from these 12 months. That means you will take the whole of the profit of these 3 months, then you now take 9 months from these 12 months. 3 months plus 9 months, that will make 12 months. So 3 months plus 9 months now. So we have 3 months profit, and that is given to be 240,000. 240,000. Plus, you are taking 9 months profit. This is 3 months profit. You are taking 9 months profit from the profit of 480,000. Notice profit of 480,000 is a profit of 12 months. So you are taking 9 months from the 12 months times 9 months, 9 over 12 times 480,000. So if you calculate 480,000 times 9 divided by 12, the profit of 9 months out of this profit is 360,000. 360,000 plus 3 months profit of 240,000 plus 240,000. That means the profit for that year will be 600,000. After 2024, the third year of assessment is 2025. And the basis period using the old accounting day will be from 1st of July 2023, and that will end as at 30th of June 2024. Where can we get July 2023 to June 2024? Back to the question. So we need July 2023. Now we can get July 2023 here from this 480,000. Remember, the 480,000 is the profit of 12 months. We will get July 2023, August and September. That means you will get 3 months from this. If you pick 3 months from 12 months, that is 480,000, then you will now pick the remaining 9 months. Notice it's 2024 profit. It's a profit of 12 months. The 360,000 here is 12 months profit. You will need 9 months from this. So 3 months from this plus 9 months. 3 months plus 9 months, that will give you 12 months. So we have 3 months from 12 months, and the profit of that 12 months is 480,000 plus 9 months out of 12 months, and the profit of the second 12 months is 360,000. If you calculate 3 months from the 480,000, 480,000 times 3 divided by 12, that gives us 120,000. Now let's calculate 9 months from 360,000. 9 months times 9 divided by 12, that gives us 270,000. 270,000 plus 120,000, that gives us 390,000. The profit for that year end is 390,000. Let's sum up the 3 years profit. 720,000 plus 600,000 plus 390,000. The profit of the 3 years is totaled 1,710,000 naira. Then you also compute the assessable profit for the 3 years identified using new accounting date. So now, new accounting date. Remember, the year of change is 2023. So that 2023 will be the first year of assessment. The basis period. Now, the new accounting year end is 30th of September. Using PYB preceding year basis, that means 2023 year end will end as at 30th of September 2023. And that, 2022. And that period must have started from 1st of October 2021 to make it 12 months. From October 2021 to September 30, 2022. Where can we get to October 2021? You know, this profit of 2021 is a profit that ends as at June 2021. So that means we have not reached October here. So October 2021 will be part of this profit. That means, you know, this profit is profit of 12 months. We can get October 2021 here, November, that is 2, December 3, January, February, March, April, May, June. That means you can get 9 months here. Then plus, this is 3 additional months. So we have 9 months from 12 months profit times that 12 months profit amounted to 720,000 plus 3 other months to end it as of September 30, 2022. So 3 months profit is 240,000. So the assessable profit now, let's calculate 9 months profit from the 12 months times 9, 720,000 times 9 divided by 12. That gives us 540,000. 540,000 plus 240,000. That is total 780,000. Then 2024 year of assessment will be profit from October 1st, 2022 and end as at 30th of September 2023 on PYB, preceding year basis. Where can we get profit of October 1st, 2022? Now, this ended at September 2022. That means October 2022 will be here. Since this ended as at September, immediately after September, we have October. This is 12 months profit. This is profit from October 2022 to September 2023, which is in line with the basis period for 2024 year of assessment as identified here. Therefore, the profit is 480,000 naira. So we have 480,000. Then 2025 year of assessment. The basis period will be 1st of October 2023 and end as at 30th of September 2024 on PYB, preceding year basis. Preceding year to 2025, the basis period should be this. So where can we get profit from October 2023 to September 2024? October 2023, this ended as at September 2023. Therefore, October 2023 will fall within this range. And this is profit from October 2023 to September 2024. And the profit amounted to 360,000. So we have 360,000 naira as the profit for that year of assessment. So you also add the profit for those 3 years. 780,000 plus 480,000 plus 360,000. Then that is totaled 1,620,000. That is using the new accounting date. I've told you that under change in accounting date, the practice of revenue is to choose the higher accessible profit for those 3 years identified. That is, you choose the higher accessible profit between the old accounting date and the new accounting date. New accounting date is 1,620,000, while that of the old accounting date is 1,710,000. The old accounting date produces higher accessible profit. That means revenue we choose to assess Ezikan on old accounting date. So revenue will assess Ezikan on old accounting date, since this produces the higher accessible profit for the 3 years identified. Therefore, since we are choosing the old accounting date, the basis period for 2023 is 1st of July 2021 to June 2022, and that amounted to 720,000. So we have 1st of July 2021 to 30th of June 2022. That amounted to 720,000. Then 2024 year of assessment. We also have 1st of July 2022 to 30th of June 2023, and that amounted to 600,000. 1st of July 2022 to 30th of June 2023. That amounted to 600,000. Then 2025 year of assessment. The accessible profit for 2025 year of assessment amounted to 390,000 naira, and the basis period is from 1st of July 2023 to 30th of June 2024. So we have 1st of July 2023 to 30th of June 2024. So, and the accessible profit amounted to 390,000. So this is the computation of accessible profit for 2021 to 2026 years of assessment. This is the requirement. So students might just compute the change in accounting date alone and neglect other years. The requirement is to compute the accessible profit for all relevant years of assessment The relevant years of assessment are not the years attributable to changes in accounting date alone. So that is why it's under must you compute for every other years, where the examiner asks you to compute the assessable profit for all relevant years of assessment. This is the end of my presentation on change in accounting date. So my next presentation, I will examine other important areas in taxation not yet covered. Thanks for watching Ezikan.